All right. Good morning, good afternoon, traders. Welcome back. Today is Wednesday, February 5th. It's 2025. This is, you've got options for Income Navigator. We're going to start off by just looking at the chart of the S&P 500. I know that you can't see half this chart, and that's okay. Don't panic. I'm going to try to explain what it is that I'm trying to show you guys. If you were um, in these meetings last couple of weeks, we were looking at how far has the market run up, and how do we measure the move and get a context around what is happening and how rare the move we're seeing is. And it's not unusual to see the market run up and find some sort of resistance at about +2 ATR level away from the mean being a 21 exponential moving average. But these labels here, these labels measure swings down, right? So we're not measuring moves up, we're measuring swings down. We can do the same on the way up, and I just didn't really want to do that to clutter the screen even more. But just to give an idea, oftentimes I will look at the swing low and then go to the swing high, and this label will tell me how much we've moved, how many points over how many days. So then I can go and kind of find recent or current moves just to get an idea. If is this something that we've never seen before, if this is something in the context of what happens very often. And odds are, if it happens often enough, there's a good chance that we may be witnessing similar or something like what we just saw recently. And right now, what I'm looking at is, what's happening in the markets. And, every time there's a headline or for whatever reason, the market goes down, right? We get messages on Discord. People, I don't want to say people are, freaking out about things, but, people want to understand what's happening and, oh, my positions are down. I thought this was going to be, easy peasy, generate income, monthly ATM machine, money falling out of my computer, but it isn't happening. Why? Right. And if that is exactly what is happening to you right now, I think that there are some things that can be addressed, right? Maybe position sizing and maybe leverage, whatever the case may be, right? And the reason I say this is because if we look at recent swings low, right, we had a couple of moves down, and we don't have to go far. Let's just go back to just in the last couple of months, because in the last couple of months we're still, in my opinion, are in an uptrend, right? There's no reason to believe that the market trend overall, this big uptrend, has changed, right? So we have to assume we're still in an uptrend. But in this uptrend, we do have times when the market is going to pull back, right? And as you can see, a lot of times we will, run into somewhere between -1 and -2 ATRs. Sometimes we'll push as low as maybe -3 ATRs, but a lot of times we punch into the -2 ATR and we bounce, right? But more so, I am interested in, what kind of a move in the percentages terms this was. So, for example, if we go back to October 2024, we saw a move down, which was about 3.1% over 12 bars or 18 calendar days. So this was a 3-week pullback. We then saw another swing down, which was 2.73%, 4 days and 4 trading days, 4 calendar days and 4 bars. Each bar represents one trading day. We saw another pullback. This is going back to early December, right? This was a swing lower, almost 5%, which is, a pretty decent pullback, right? I'm sure there were headlines, and I'm sure that the media possibly made this feel a lot worse than it really was, right? But in about 14 calendar days, 10 trading days, the market pulled back almost 5%. Then we had another swing to the downside. This was like almost 4%, 3.6% in about 4 bars or 1 week. So most recently, right, we just touched all-time highs on S&P 500. This is back in January 24th. And then since then, we had a couple of decent gap downs on some news. First was NVIDIA 2 weeks ago. This past Monday, this was the tariffs, and whatever the case may be, we should not so much care about, why. We want to understand what is happening, and um, how do we look at it and get context about what is happening, right? Just forget about the headlines. Don't let that noise, or if you're trying to tie headlines to price action to justify, to find a reason, why we're seeing um, what is happening. you know my answer to this would be, if you knew the reason why, would it make your losses feel any better? Probably not, right? So I'm not saying, live under a rock and don't pay attention to what's happening around the world. I'm just saying that, don't let the headlines necessarily drive your decisions. Look at the price, look at, what has happened before, get some sort of a context about what's happening. And, if you find evidence in the chart that leads you to believe that we went from an uptrend to maybe we had no trend for the past 3 months and now we're rolling over, then yes, maybe you can start to make slight adjustments to your overall trading strategies going forward. I wouldn't say go out and, get rid of all of your positive delta, put on a bunch of negative delta trades. And, I think it's kind of irresponsible. So the reason why I say that, if you are feeling a lot of pain in what is happening in the last, couple of weeks, maybe a couple of months, we're not really seeing a bearish market, right? We're not down 10%. We're not down 20% from the highs. We're just moving somewhere between, 3, 4, 5% from swing highs. Is pretty normal, right? Whatever that normal is. So it is normal. You shouldn't see something that makes you extremely uncomfortable, because if we do see a 10, 15, 17% pullback, hopefully not in 1 or 2 weeks, maybe it's going to take a couple of months, but if we do see a decent pullback, you can only imagine how much more the pain you may be feeling right now will feel like. Right now, so we just recently had a move down. The most recent, right, last two gaps on Nvidia and on tariffs, we're down from highs to lows. Low was this past Monday's low. It's about 3.3%. We're in about 6 trading days so far. And, we bounced back. We are now somewhere between the mean, 21 EMA, and we're not even at +1 ATR. So to say that we're overbought here, that's not the case. We're definitely not oversold. We're just kind of in the middle of nowhere, right? So what that tells me is, I don't necessarily want to be bearish here, right? We're not below the 21 EMA. Under 21, I'm ready to see market continue to push lower. We pushed lower, bounced off -1 ATR. Now we reclaimed 21 EMA. So to be bearish here is maybe a little too soon. I'm more or less neutral, because I think the price right now is pretty neutral, right? And I think that unless there's more headlines, unless there's more um, unknowns, right? There's a lot of known unknowns. We know there's a lot of stuff that's happening in Washington. There's a lot of changes coming in place, and there's going to be headlines, but this is a known unknown. So I would say that to a certain degree, that all of that is already being priced into the markets. Now, if we get an unknown, right, something that we don't know and we don't think we don't know, then, right, the market's going to have to reprice. So, for example, if the Fed comes out tomorrow out of nowhere and cuts rates to zero, right? That's an unknown. We don't know. We didn't think this was going to happen. We didn't know that they were going to take action at all. We don't know what they know, right? So all of a sudden the market is shocked. And even though, we can make the case that cutting rates to zero today or tomorrow would be a good thing, right? Flood the market with cash, blah, 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 blah. But at the same time, we would say, well, what do they know that we don't know? Why are they cutting rates to zero, right? They're obviously prepared to do something bad is happening, and this is the reason why they're cutting rates to zero. So if something like that happens, I think the initial reaction will be to the downside, and then potentially maybe we grind back up. But As far as headlines go, I wouldn't try to tie every single headline to what is happening in the market. Just pay attention to price, look at previous swing highs and lows and where we are right now relative to those levels, and make your decisions based on what the price is doing, what the price is telling you, not what the media wants you to believe. Right. And we could zoom out. I mean, again, I think this, if you're using TradingView, I think this is a pretty cool tool, which is an info line. And you can just, go and measure these swings and, see how often we go up 10%, see how often we go down 10%. Because I guarantee that when the market goes down 10%, the media is going to make it sound like we're entering the new Great Recession. But if you go back and actually look at some previous moves, it may not be as bad or as terrible as the media is making us believe. So from here, I don't know if we're going much higher, if we're going much lower. Right now, we're just kind of neutral. I do think that the longer we stay here, right, we had a couple of gaps and the market seems to be able to grind back up. I think the longer we stay here, the higher the chance we're going to continue to make all-time highs, new all-time highs. That's my thinking. If something changes, I'll obviously post charts and whatnot and share my thoughts. So if the price starts to tell me differently, until then, I'm just kind of neutral here. And that's going to reflect also in the way that I am going about managing my positions. And I'm going to talk about an adjustment that I made today to one of my hedged income trades. Hopefully this will kind of come together and make sense to you as well. If you want to take a look at CL, which is crude oil, and I said that we've been in this massive channel, just kind of drifting sideways to lower, right? Where I would say this is more neutral than bearish, even though, the price has come down from 80 down to about 71 right now. I do think that there is some sort of, whether it's artificial or not, support somewhere in the mid 60s. I don't know, but that's what I have to believe. I have to assume that if we come down somewhere in the, maybe mid to high 60s, I would be looking to put something on with positive delta. Right now, I think strangles would probably make sense. I wouldn't want to be extremely bullish here. Maybe I would, if I was to put on the strangle here, and then we came down somewhere to, let's say, 70, and then we started to move back up, right? I would use some of that credit from that short strangle to buy a, even maybe at the money, maybe slightly out of the money call debit spread and play to the upside. But my goal would be mostly to control my net delta of my position, right? If I started with a short strangle, I would probably start with a slightly negative delta. And if the market or if the price of CL would start to creep higher, obviously short strangle would start to accumulate negative delta on the way up. So I would neutralize or convert that negative delta into slightly positive or maybe neutral delta by introducing a call debit spread. Yes, you would be possibly giving up some, or depending on what you pay for that call debit spread, but you would be giving up some of that initial credit on the strangle, but you would be leveraging that credit that you collected to potentially increase your profit potential with that call debit spread. That, I mentioned this maybe a couple of weeks ago. I still think that this trade makes sense here. And I don't think that this is something that you have to do today or else you're too late to this party. But this is just kind of my idea about what kind of trade I would do in oil if I had to. We can look at gold. Gold's making all-time highs. Where I think we're getting into this overextended territory, but at the same time, you could, if you just zoom out a little bit, and you can see that gold has these periods of like doing nothing and then out of nowhere taking off, going up, going sideways, going up, going sideways, going up, going sideways. This could potentially be a breakout, even though today's candle is not the most bullish candle I saw, but maybe this is a breakout and we could maybe continue higher. I can say that chasing up here, I wouldn't do that. If I was bullish and I was looking for a continuation to the upside from here, I would be a buyer on dips. As you can see, even as gold breaks out, there's always opportunities to buy on pullbacks. So maybe buying on pullbacks or getting long on pullbacks makes sense. We can stay overbought for way longer than anybody could imagine. And, MACDs right now are still very bullish above zero. So trend is in place. We are a little bit too far away from the mean. I think it's a little overextended. Would I go out and sell a bunch of naked calls here? Probably not. Maybe a strangle, but maybe a strangle. But I would want to make sure that my strangle starts with a net negative delta, and then if we do get a pullback towards the mean, all right, we can maybe look for some kind of potential support, right, somewhere around 27.75 or something like that, right? There's a small gap here. Maybe as we come down into this 27.75, 2800 area, I would be again looking very similar to what I just mentioned with oil. I would be looking to leverage some of that credit to pick up a call debit spread to participate on the upside in gold. One more thing I'm going to look at is everybody's favorite, TLT, right? We saw bonds come down. We talked about why bonds are down, even though rates are coming down. So we're not going to go into that. But, sometimes I look at these symmetries, and these are measured moves. So we saw a swing high from, this is November 2024 to about December. So in about a month, we moved up. And, if you wanted to use our good old money or info line here, this can tell us. So 6% move in TLT is not a lot, right? We see this happen quite a bit. So we saw a 6.07% move to the upside in about in 13 bars in 3 weeks, 18 calendar days. Then we saw a nice dump lower, and now we have moved up almost 6.8% in about the same time frame. So this is not something we haven't seen before. The question is, do we continue higher, or do we pull back and then continue higher, or do we just completely roll over and die? It's kind of hard to predict. I think that chasing up here, just given that we are at +2 ATR away from the mean, I'm not saying that this thing is going to roll over and die here, but what I'm saying is that chasing long may be a little too late. I don't think that this is a high probability outcome setup, right? I'm not saying that it's not going to work. I just don't think that the odds of a profitable outcome are in your favor right now. If you are bullish, I would probably look for the price to cool off a little bit and let the mean, or whatever you use. I'm using 21 EMA. I would wait for the mean to catch up to price, or wait for the price to come back down to retest for support. But I probably wouldn't be chasing up here at +2 ATR. I do have a covered strangle in TLT, so that's working out just fine. I'm long 500 shares of TLT, and I am short a strangle. I'm trying to look at where my strikes are. I think my out of the money call is at 90. And my out of the money put is somewhere in, I think it's 84. Those have 16 days to go. So what's going to happen from here is if TLT is above 90 at expiration, I will have to let go of those 500 shares. That's going to be a capital gain there because my cost basis is below 90. So that's income stream 1. Income stream 2, I was able to collect the credit by initially selling a put to get a sign on those 500 shares. Plus, I sold a strangle once I was already long the shares. That's income stream 2. Plus, there's a dividend that was just paid. It hasn't been paid out to the shareholders just yet, but I'm pretty sure deposit is going to show up any day now. So that's income stream number 3, right? So, and that was the idea in the TLT: sell a put to get assigned. Once get assigned, sell a strangle around it. If the price goes up and you get called away, you lock in a capital gain. If the price goes down and the short strangle expires, you'll sell another covered strangle, right? Continue to reduce cost basis. So that's income stream number 2. And then while all of that is happening, you get dividends. And I think that TLT right now is paying somewhere around 4.1 or 2% or something like that. So that's pretty decent as well. All right, so that's that. Those are my thoughts. I mean, I'm not gonna, try to make the case why we're going higher or we're gonna roll over and die. And these are my thoughts about what's happening in the markets. Hopefully, you find this useful, and um, your feedback is also very valuable to me because it helps me understand, things that I need to maybe focus on. And if you don't really care about um, the S&P, gold, and any of this stuff, or the charts or whatever, then maybe we won't waste time on it and focus more on things that you do want to talk about. So right now, what I'm going to do is I'm going to shift over to Option Explorer, and we are going to talk about this one position. And this applies not just to this um, not just to this specific trade. It applies to this specific trade style, right? Because a lot of my trades are very similar. If you look and compare their risk graphs, this is what um, 112 has evolved to. As you can see, um, this is still a 1-1, which is a put debit spread, except it's in June expiration cycle. And then it's a 2, so it's a 1-1-2. I'm short 2 puts in 14th of March expiration cycle. March 14th is at 37 days. You can see it here. And if you are curious about to see what happened to this trade from the start, this is a trade ID 3087. If you are on our Discord, you can go into the trade alert section and just punch in this trade ID 3087 in the search, and you will see every time I make an adjustment, or if there's anything for me to add to the trade, I will leave it in the trade post in a thread, so that you could piece things together and kind of get a better idea of what I'm doing, why I'm doing it, and you can ask questions if you're not clear, and that's where a lot of our topics for different conversations is going to most likely come from. Right? You let me know what you don't know, because if you don't, then I don't know what you don't know. So this trade started off, and I'm going to go back and see if I can share the trade log for this trade. I can't. Let's stay on the risk graph. So the trade started off in early January. This was January 6th. I bought to open the original put debit spread, which was June 30th expiration. And the strikes were, I was long 5,400. I was short 5,100. So 5,400, 5,100. It's a 300 point wide put debit spread. And I sold 2 of the February 24th 55.50 puts for $20.50. And then on January 13th, which is 1 week later, the market came down a little bit. And the naked puts that I sold for $20.50, maybe we can go back and maybe we can go back and I can show you what this looked like. We're going to go back to January 13th. This is, this was about 10 o'clock or so a.m., right? So we can see that from the time where I put this trade on, right? 7 days has gone by. The price of the underlying asset has moved 2 standard deviations to the downside. Implied volatility increased by 40% or so. This is what my P&L of this trade look like. We can see that my short naked puts that had 42 days, they reached delta 21.35. I sold these puts for $20.50. Now they're worth $48.50 or something like that. Right? So they increased quite a bit. And I'm pretty sure the price of the put debit spread that I bought out in June has increased as well. But the puts have increased way more than the put debit spread. And since I am short the naked puts, right, this created a net negative P&L. I hope that makes sense. Right? So now I have a problem, not so much with the put debit spreads because, well, their job is to kind of hedge this position, but are they really hedging at this point? You can make the case that, and if you wanted to say, well, where is your hedge? Why is this position down? Right? What I'm going to say is that while my short naked puts are getting in trouble, the put debit spread is doing its job. I don't expect it to cover all of the losses. That is why this is not a set and forget type of trade. You don't put this on and walk away until the last day before expiration of your short naked puts to check in on this trade, because what's going to happen is if we continue lower, you can see that my T plus 0 line is going to dive and the put debit spreads are going to continue to increase, but they're not increasing as fast or as much to offset any of the losses from the naked puts. So the naked puts is where the problem is. And that is what I need to always, always, always think about and protect. The put debit spreads are there in case I need to fix my problem. Again, my problem is in my short naked puts. If I need to fix this problem and it's going to cost me money to fix this problem, I'm going to look at what is the value of the put debit spreads and how I can extract some of that value from these put debit spreads. They are a hedge in the end, right? So the hedges are going to come in and cover the cost of me fixing my problem. It's kind of like if you buy a house and you buy insurance, you know, hurricane hits, right? And destroys your roof, right? The roof is what needs to be fixed, and the insurance is what's going to pay for it, right? So it's a similar idea. Yes, there's other moving parts here, and maybe it doesn't really work exact the same way, right? Because the insurance can drop you, but um, that's the idea. You have to worry about the asset, right? This is where your risk is. Your risk is in the naked puts, and for me, it's when the delta of my naked put, if I sold this naked put and it was a delta 10 or a 9 or 11, right? Somewhere in that neighborhood, when it doubles, it doesn't mean that, you have to stop doing everything you're doing and, take a loss or this simply means that it's time to do something about your trade. You need to start to defend your position. It doesn't mean that if you do nothing and the price continues to move against you, that it's too late to do anything. I just think that this is a perfect time to step in and do something before it becomes too late. Can you wait for the price to test the short strike before you do something? Yes. Is it the right thing to do? In my opinion, it's late because look at my P&L or my potential P&L line, right? If I was to wait if I was to wait for the price to touch my short strike, we'll be down here somewhere. And my loss will be probably somewhere around 16,000. Now I'm only down 2, right? Now, I want to address real quick. Sometimes I get questions like, hey, what do you stop on the short strike or on the naked puts? Is it 2x credit? Is it, you know, something like that? I don't necessarily look at it that way, right? Because this is not it's not a campaign for me where I'm going to slap on an iron condor every 2 days or or 3 times a week, and then regardless of what happens in the market, I'm just going to, if it reaches 2x credit, I'm going to take it off because I have the next one coming up in like 2 days. So I'm just trying to recycle the same capital and take advantage of probabilities. Even though we do have um, probability stacked in our favor, when it comes to managing these trades, what I'm looking for is I have a problem with the naked puts. I need to fix this problem. How do I fix it? Well, the way I fix it is I'm going to possibly roll these naked puts down, right? And down and out, which means I'm going to extend my duration by maybe a couple of weeks, maybe 3 weeks, right? Depending on how much time. So, like, if I'm at 42 days until expiration here, am I going to extend my duration by 50 days and roll to like a 90 DTE? Probably not, right? I think 42 days, somewhere between, and we talked about this before, somewhere between 30 and 60 days is the window, or at least that's what I believe, that this is the prime, this is the window in where I want to operate on my income side of the business. This is where I want to be short premium. You can make the case that, hey, if you sell a 90 DTE, those are more forgiving. Yes, the theta is less, less exposure to volatility, and you may enjoy that a lot more, and that's fine. That is what that works for you. That's great. Do what works best for you. For me, I want to be in that window somewhere between 30 and 60 days. So if I'm at 42, I may extend duration, to add another 14 days on top of this 42. So push it to as close to 60 days as possible, right? Something like that. It all depends on how far out I can push this. So there's no, right and wrong. Everything is very discretionary here. If you want to move it out just by 1 week, great. If you want to move it out by 2 weeks, great. As long as, right, the goal, we need to know where we're going and we're trying to figure out how do we get there. Right? So for me, this adjustment, right, I don't want to wait for I don't want to wait for the short strikes to reach delta 40 or 50 to start to make the moves. In my opinion, it's already late. It's just going to cost more. I'm going to have less options available to me to make adjustments. Right? So I would rather act a little bit sooner than later. So when the delta gets to about 20, 22, 25, you got to move. You got to do something. So what I decided to do here, with only 7 days in, I bought these 5550s back for $48.95. And then I went ahead and I sold March 14th, which was 60 days until expiration, 5,400 put. The initial delta of this put, and I don't know off the top of my head, I don't want to screw around with what you're seeing on my screen. So what I'm going to do is I go on Discord, and you should too, when you have time to do this. You go back on Discord, you type in trade number 3087. There's a screenshot of when I took this trade, and my short strike delta was 10.03. So it went from 10 to, what did I say, 21? Right, delta went from 10 to 21.35. It's time to move. What am I going to do? I'm going to buy these two. So I'm buying to close. Yes, this is rolling, right? And if you don't like rolling, um, then it's not rolling. It's closing out a partial or part of this trade for a loss and reestablishing a new position. And then I rolled these naked puts down to March 14, and the strike was 5,400. 5,400 was not a delta 10, so it wasn't perfect. I would prefer to roll it farther out or farther down in price, right? But my initial move was to roll it to where I can, move away from the problem, right? The problem is the price moving towards the short strike. So I moved from 5,550 down to 5,400. This also decreased my delta just a little bit. I believe this adjustment, and then I could scroll and look at my notes. I was filled for $1.80 credit. I believe that this kind of an adjustment would actually relieve some of the buying power. It wouldn't request more buying power to be added to this trade. I think that because we are going farther out in price and we're adding time, tastytrade actually relieved some of the buying power for this adjustment. So yes, now I have to be in this trade a little bit longer, right? Instead of 42 days, now I'm 60 days on the front month, but I'm a little bit farther away as far as my puts go. And now I have to think to myself, okay, so I'm going to roll my naked puts down and out, right? I collect a small credit. What happens if the market's going to bounce? Nothing, right? These puts are going to the 5,400. They're going to lose a lot of this $50 premium quite fast, right? So that's going to work in my favor. And my put debit spread is going to lose some of that value as well, but that's okay too, right? I'm focused on my short naked puts because that's where, or that's the income generating part of my business. So I kind of fixed my near term problem. Now from here, the market could go one of two ways. It can go up or it can go down. If it just sits sideways, I'm okay, right? If it goes up, I'm okay too. If it continues to move lower, right, I don't want to wait for these puts to become Delta 50. Again, I need to act before it becomes more expensive than what I want it to be. I have a choice to make. Now, if I have the room, and again, everything has to be within the context of your overall account, right? Like if you're already strapped for um, buying power, if you don't have the buying power, then obviously adding anything, like for example, you can roll these puts. I wouldn't really want to extend my duration by too much. I'm already at 60 DT, right? I don't want to wait 6 months for these naked puts to expire, right? I want to stay within this window. So I'm going to roll down. Maybe I'll add an extra naked put to compensate for that roll because you'll never roll down in the same expiration cycle and collect the credit. That's never going to happen. If you roll two naked puts down, you can look at the pricing, right? 5,400 is at $50.37. If you roll these down 50 points, there's a debit, right? Because 5350s are trading almost $5 less. So if I was to roll these two naked puts down 50 points, there's a $5 deficit. Where is that $5 deficit going to come from? Either I have to increase the number of naked puts from two to maybe three, maybe to four. But then again, that's also not my favorite. Like I don't want to go from two naked puts to four naked puts. That's going to take up more buying power. So I'm actually adding risk to the trade while trying to solve my near-term income problem. Adding too aggressively, adding size aggressively is not my favorite, right? So maybe that's not the best option. Maybe the option is if I was to roll these 5,400 puts down and I have to pay a debit, guess who's going to pay for that debit? Yes, the put debit spreads, right? That's the insurance. That's the hedge. Maybe I sell the entire, I mean, I don't know, depending on what this put debit spread is worth, maybe I don't need to sell the whole thing. Well, I only have one. So if I had to sell some of it, it's either I'm selling the whole thing or I'm not. Or I can look to roll, right? This is a 50, 400, 50, 100. There's 300 points. Maybe I roll the 5,400 put down 100 points, maybe 150 points. I just need to collect enough credit from this put debit spread to pay for the adjustment on the naked puts. Right? So if I'm rolling this naked put down maybe 50 points, maybe 100 points, maybe I'll roll it down and out one more week, right? So for example, if I was to roll this 5,400 and pay $50 for it, I'm rolling it down to 5,300, also size the same, two contracts. So I roll it down 100 points and out one more week, right? So I go from 60 DTE to 67 DTE. There's a deficit, right? The puts that I'm looking to sell, they're at $45. That's what I'm collecting, but I'm paying 50 to close out the puts with 60 days. There's a $5 debit. That debit is going to come from me rolling the 5,400. I'll try to roll it down 100 points. If rolling 5,400 put brings in a $5 credit, right, total $500 credit or whatever the dollars work out to be, then that is enough to cover the cost of this roll down and out on the naked puts. Now you got to keep in mind that, rolling down, right, rolling two of these puts, you have to understand uh, how much you need, how much debit you have in dollar terms, and how much you will bring in again in dollar terms by rolling one of the, because you only have one on the long leg of the put debit spread. So if I'm paying $500 to roll my naked puts down, I need to roll my long leg of the put debit spread down to where I can raise that $500 from and cover the cost. So essentially, I will have sacrificed some of my put debit spread. It'll go from, maybe 300 point wide to 150 point wide. Maybe I have to roll it 200 points. Maybe I have to close the whole thing. I don't know what this put debit spread will be worth in the future. Sure, you can use some pricing model to predict, but right at the time when it is happening, right, you want to model the trade, look at how much your naked put roll down and out is going to cost you, if it will, and then figure out where am I going to get the credit I need to cover the cost of this roll down. Now, we're talking about this adjustment here, right? And I only have one put debit spread. But remember, I do this trade campaign style, which means that every time my naked puts roll off, right, when the market isn't going down, when volatility is not rising, when the market just does what it does most of the time, maybe it goes up a little, maybe it goes down a little, but over time, the naked puts are going to lose value. And when they finally come off, because there is a time difference between my naked puts and my long debit spreads, I get a layer of put debit spreads left over, right? And then I put on a new trade. When the naked puts roll off, now I have two put debit spreads. So at some point in time in the future, when I need to defend my income part of the business, I may have one put debit spread. I may have as many as 5 put debit spreads to choose from. Which put debit spread am I going to sacrifice today to cover the cost of fixing my near-term problem on the income side of the business? Right? I know there's a lot to think about, and you probably will have to rewatch this a couple of times, and that's okay. But I want you, I mean, we are literally talking about this entire trade and how it needs to be managed. And don't want to go into like the specifics, right? Because you don't get caught up on, oh, is it Delta 20 or is it Delta 22 or 21? It doesn't matter. When you have to make an adjustment, you roll whatever, or you buy to close and sell to open, whatever is the problem. And then if that problem is costing you out of money, debit, you figure out where or what you need to sell, right? Assuming you have these put debit spreads. If you're just short naked puts with no debit spreads, then you have nothing to sell. And unfortunately, you're in a position where, you know, you don't have the hedge to compensate. It's like you bought a house with no insurance and then you got hit by a hurricane. Who's going to pay for the new roof? It's going to be you, right? So that's also a scenario, and that's why I often say, I want to build up as many layers of these put debit spreads as possible, right? Maybe I will never need to use them, and I hope I don't ever have to use them, which means that I don't have the problem with my income generating part of the business. If I don't have to touch the hedges, that means that my roof is in place and I don't need the fixing, right? Let the near term or shorter term income trades work, and the hedges are only there in the event that you have to fix something. That's when that comes into play. And I'm going to touch on that in just a second, because the adjustment that I did today, it was not just to increase my income portion of this business, but my goal was also to continue to add layers of protection, right? And there's a trade off, obviously, and we'll talk about that in just a second. But let's just go back for a second here. So this is where we are, right? My naked puts are being pressured. I decided to roll, collected a $1.80 credit, right? And this is what my risk graph looked like before I made the adjustment. It's not some adjustment that all of a sudden will take the trade from being down $2,000 to being up $7,000, right? All I did was I just moved my naked puts down and out. I didn't cover anything, and my risk graph still looks similar, except my problem is now a little bit farther out of the money. Right? You can see that my problem is here, right, at about 4.8, or maybe like 5%, maybe 5.5% out of the money. And then by making the adjustment, my problem is now about 8% out of the money. But my T plus zero is still going to dive if we continue to the downside. So just because I made this adjustment doesn't mean, oof, my job is done. I'm going to go away and, look at this trade one day before expiration. You're opening up to a bunch of problems that you don't want to have. So you need to continue to monitor and be prepared to make an adjustment. And if you're making an adjustment, it's going to cost you money. You should already know where that cost is going to be covered from, or what is going to pay for that cost. Right. So this was my adjustment. And then we can go to today. So this was 7 days in. We're going to go into today. And let me just remove. So this is what this trade looked like earlier today. All right, you can see that we were down, and I don't remember what it was, 2,000 something dollars or something like that, right? So now we're 30 days in. So 23 days have gone by since then. We went from being down 2,000 to plus, 1,000. Okay. We still have 37 days to go until expiration, right? The 5,400 put, remember, I sold that put for $50.75. Right, I bought the old put for 48 and change, and I sold this one for $50.75. It's been 23 days since that adjustment, and now this put is worth $8. So from 50, right, let's call it from 50 down to about 9, right, this put lost about 80% of its value since then. So now I still have $8.70 times 2, right, which is about $870 worth of extrinsic value with 37 days to go. And now I look at my charts and I'm not super bearish, I'm not super bullish. We're kind of now, remember, I started with, looking at the chart, and we're between the mean, which is a 21 exponential moving average, and +1 ATR. It looks like the market was able to shake off the headlines that were coming in last couple of weeks. So again, if I was super bearish, I probably wouldn't touch this trade, but I'm willing to bring in a little bit extra income in this trade by rolling my naked puts a little bit higher, which means I'm going to be collecting a little bit more credit, right? I'm going to take a little bit more risk with this trade. So now you could say that I'm undoing the fixing that I did, in the last step, but I'm rolling these puts. I'm going to buy back the 5,400 puts, and I'm going to roll them up to 5,600. So I am moving, right? It's 2, and then sell to open the 5,600. So now these 5,600s are delta 8, which is, assuming, again, we have to assume a lot of stuff. We have to assume that these puts have, 90% probability of profit, 90% probability they're going to expire worthless. So the odds are still in my favor. I'm just moving them a little bit higher for an additional, right, $6.60. I think the actual fill was closer to $7, something like that. Right. So I'm collecting a little bit extra income on the naked puts. And then I'm not greedy, right? If I was super bullish, I would just roll up these puts and, so what? I increase my delta from +2 to +6. I increased my theta from 52 to 75. I also increased my vega, which, right, the volatility risk, from -70 to almost 190. Right? But because I'm not super duper bullish, right? Remember, going back to that chart, I'm kind of neutral to bullish. I'm going to add another layer of put debit spreads to this position, which will take away some of this credit that I'm collecting. And I'm okay with it, because what's going to happen is, in 37 days or in 30 days or however long it takes for these puts to completely lose, maybe another 80% of their value, and I take them off, this is going to leave me with what? Not one, but 2 put debit spreads. Because what I'm also going to do, I'm going to go to June 30th, which is the same, I think it's the same expiration cycle where I had the original put debit spreads. So we go to June 30th. Right, 145 DTE. And I'm going to see, I already have the 5,400, 5,100. This is the original put debit spread. And I'm going to add a 5,200, one, and then I don't want to, I'm spending $42 to buy this $5,200 put. I would like to get, as close to 300 as possible on the width of this put debit spread. I was able to model a trade that was 49.50 was the strike on the short leg, right? And this gives me earlier today. So now this adjustment is going for a net credit of I don't know, maybe a 125, maybe a $1 credit. Earlier today, I was filled for $2.30 credit, which is divided by two. It was $115 in total. So I increased my income, net income for this trade by $115, right? I took a little bit more risk, right? So there's a trade off. You want more income? Okay. You're going to have to take a little bit more risk. Okay. But I'm just not going to take risk blindly because I'm also adding another 250 point wide put debit spread. I wish it was, 300 or 400 wide, but it isn't, right? I still wanted to collect a net credit on this adjustment. So I rolled up the naked puts, collected a credit, and then I spent some of that credit to pick up an additional put debit spread. So now, right, let me get rid of all this. I'm going to answer your questions, guys. Didn't mean to keep you for this long, but this is what this trade looked like before, and this is what it looks like after, right? So my problem now is 7% out of the money, and before it was over 10%. So my problem is now closer at the money, but I have a little bit more credit, a little bit more income, and I have two put debit spreads. What that means is that once I wait and let the naked puts that I'm currently short at 5,600 roll off in 30, what did I say, 37 days, right? Once these naked puts roll off, this will leave me with two put debit spreads, which will be my insurance policy, so to speak, for another tranche of these 112s, right? This is T1, so I mark these as tranche one. And I have multiple tranches going at the same time. So each tranche, I want to build them up, have a 112, and to have several layers of leftover. These are going to be leftover as soon as this naked put rolls off, or if I close it early for some fraction of what I initially collected for it. I hope this makes sense, guys. I know that, this is like a lot of moving parts. Maybe if you're just getting started, you're not sure, and you are in the right place. We're going to teach you all of these things. And, for now, this is how I operate as far as these 112s go. I talked about the 112s and, where I saw these structures have a problem. We had the put debit spreads in the same expiration cycle with the naked puts. We would take off the naked puts a little bit early, which would leave the put debit spreads with only maybe 3 weeks until expiration. And when I really needed the insurance to cover cost of adjustments, I just, number one, didn't have enough of the put debit spreads, and they didn't have enough time value. They were worth almost nothing, and they were only 50 points wide. So making the adjustment by going a little bit farther out in time with the put debit spreads, we kind of solved this problem of having the insurance policy that we need when we need it. Hopefully that makes sense. We are going to continue to talk about these kind of trades, and I really like to use these real live trade examples to show you, right, what I'm doing, how I'm doing it, why I'm doing it, giving you a chance to ask questions and give you the answers in real time. Let's take 2 minutes to answer some of these questions. I know we just had the bell ring and the market is now closed. So we'll answer a couple of questions and I'll let you guys be on your way. Let's see. First question, will you preferably use the put debit spread from the trade itself or rather use some of the leftover put debit spreads? I think I just answered. I mean, I'll sell whatever I can except for the far out of the money calls. Selling calls will bring you the credit, but this doesn't necessarily fix the problem, because what happens is if the market reverses, kind of like what would happen here, right? The market came down where I made this adjustment. This was the first adjustment. I rolled my initial layer of the naked puts, I rolled them down. I didn't sell a put debit spread to cover the cost because there was no cost. But if there was a cost, and instead of selling the put debit spread, if I sold the call on this move higher, guess what? The problem on the downside is kind of fixed for now. But now I have a problem on the upside because those short calls would be on fire, right? So I don't like selling calls to fix my downside problem. I would rather have a couple of extra layers of put debit spreads that I could potentially sell to cover any expenses associated with rolling naked puts down and out. Hopefully, this answers the question. If you close the whole thing, would you leave your short income puts naked? That's a good question. You know, I think it also, um, this is assuming that I don't have any other layers. Like if this is like my last, and this is the line in the sand that I'm drawing, like, all right, I'm going to make an adjustment. I'm going to let my, I'm going to get rid of my last put debit spread. I'm rolling out my puts. That means the market's been going down for a while now. I need to just really reconsider the whole thing, right? Because let's not get too far away from the fact that this is a bullish position, no matter how you spin it. Why is it a bullish position? Because on the downside is where our big problem is. I know we have room to the downside. I know we have a high probability of profit here. And we also have positive delta. If the market is just moving against me and I already spent some put debit spreads to make an adjustment and the market continues to move against me and I made an adjustment again and now I spend more and now I have no more put debit spreads. Hey, the price is telling you you're wrong. Your bullish position is just in the wrong in the wrong place at the wrong time, if that makes sense. You should not be holding on to a bullish position. You need to revisit the chart and figure out why you're still holding on to a bullish position when the price continues to move against you. At some point, you have to um, pull the plug, right? Is it a 3x? Is it a 5x? I can't tell you what X that is. I think it's more about dollar terms. Like, are you comfortable taking a $15,000 loss in a trade like this? If the answer is no, then you need to pull the plug on this trade before you get there. Right? This trade is not mechanical enough for me to say that, hey, I ran some back test and when you get to 4x, this is extreme and it's never going to be more than 5x, credit, blah, blah, blah. It doesn't really work that way. There's a lot of discretion that goes into play. And again, we just want to act early enough and recognize trends and patterns early enough to get out of the way. Sometimes the market's going to do what it will do, and you want to make sure that you're not in the way of this market. And if I really had to do something, then you know what? I would probably roll the naked puts down and out, and I would probably sell something way, way, way far out in time to compensate for that roll, assuming the market isn't going to zero, right? I will have to deal with that far, far, far out in time, whatever I'm selling, to bring in the credit to pay for the roll. But that's a little bit too advanced. And yes, that's adding risk to this trade. I think the easiest thing to do is just get out of the trade. If it becomes too much of a pain to deal with, get out, because your job is to preserve, and there's always other trades to be made. Jeff is saying, when you do this type of roll, how does this affect your profit target on the rolled short puts? As far as short naked puts, I mean, here's what I can say, right? I originally sold the puts naked, right, for $20.50, right? And maybe I was looking to make, I don't know, 80%, 90% of that $20.50, right? So 20.50, I took in $2 and 2,000 and change, plus I spent whatever I spent on the hedge. I think the original uh, profit potential on this trade was somewhere around like $1,000 or something like that, right? And then I bought it back for $49 and I sold another put for $50. So I collected an additional $1.80, right? And now I was in the position to buy back those puts for $8.95 and sell another set for $16.25. What's going to happen is eventually, when my time until expiration, right now I have 37 days, and now I don't really, again, remember my window to operate is somewhere between 30 and 60 days. Now, if I had this trade with like 17 days until expiration, if am I rolling these puts up in the same expiration cycle? I guarantee you that's not the case because I'm already out of time, right? So essentially, I want to babysit these naked puts long enough until I run out of time or I run out of premium or both, right? Like if this trade had 14 days to go and this put was trading for like $1.50, I would just close out the whole thing and forget about it. Right. So I don't know. I don't really have a set profit target per se. Yes, I want to milk as much premium out of these puts as possible. Right. So essentially, I'm working with the time until expiration and how much premium is left. And eventually we'll get there, right? We can't stop the time. And as long as the time is passing and the market is not crashing, the premium is going to come down as well. And once you reach the point where it's like, do I really want to hold this for, 2 more weeks for an extra $1.50? Probably not. Get out, right? And leave the put debit spreads, which will hedge your next round because if I'm getting out, well, I'm getting in somewhere else, right? Because this is a business. We take it off, we put it on. We take it off, we put it on. And we go on and on and on. So if I'm taking this off and not rolling it up in the same expiration cycle, but I'm establishing a new position, if I'm giving up $1.50 here, yeah, maybe I'll go on the new position a little bit higher on Delta and pick up that $1.50 on the new trade. Hope that makes sense. Let's see. When taking profits on the shorter term naked put, what percent of the credit are you trying to receive? When taking profits on the shorter term naked put. Yeah, I mean, I think I just answered this question before I read this. So, if we get to about, 80, 85, and 90%, again, that last 10% is going to be sticky, especially if you, for example, and this is kind of a skewed example, but I think it makes sense, right? The last put that I sold, the one that I bought back today, I sold that put. It was a 17 Delta put. So it was, closer at the money. So it was higher risk put, but I sold that put for $50.75 and I bought it back today for $9, for $8.95. Right. So if I sold it for $50.75 and I bought it back for $8.95, I made $41.80 out of max potential of $50.75. That put has lost 82% of its value. Now, is there still $8.95 to be made? Yes. But it'll take 37 days to make the remaining 18% of that premium. I sold that put with 42 days for $50.75. Now, with 37 days to go, right? That put has lost 82% of its value. So now I have to stay for 37 days more, but I'm only going to collect the remaining 12%. To me, it didn't make any sense. So I look at percentages kind of like that. JT says, thank you answering my question. Under what condition is your trade plan? Do you also say, selling naked calls? Yes, I think, naked calls could be a very discretionary trade here. For example, just looking at the chart, and this isn't the best software to, use for charting, but, if we came down here, We did what we had to do if we did, right? And then we bounced, and then we came down, and we bounced again, and we're in an uptrend. So you say, you know what? Every time we get too far away, whatever that measurement that you're using, maybe you're using standard deviations, such as, in terms of Bollinger Bands, in terms of how far away, in terms of standard deviations, are we away from the moving average, or maybe you're using average true range or Keltner channels to measure when we get too far away from something, right? I use 21 EMA. So if we are at like +2, +3 ATR, and you have lots of time until expiration, maybe you go out and sell one, or you sell a call. You're adding a call. You don't have to, but selling a call, you're introducing upside risk, right? In exchange for that premium. So there's an even exchange risk for premium. You have to be aware of that, because if you did something like this, let's say maybe up here, right, and then maybe from September you had all the way out to December on these calls. If you sold a naked call up here somewhere, and then the market went down, and you felt great about that naked call, and then we started to run up, and you were like, oh man, maybe I'm in trouble, and then we had a pullback, and you said, see, good thing I didn't do anything about that naked call. Guess what you're saying up here? That naked call is burning a hole in your head. Right, so you have to be very careful on adding naked calls. You are taking on risk in exchange for that premium. Just be responsible, right? And you can time these naked calls. Like if you sold a call up here, and then we came down, from September 19 to about October 7th. Some time has passed, and the price has reverted a little bit. I guarantee you that. Well, I shouldn't say guarantee you, but I would assume that the price of those calls has reduced. Maybe they lost 50% of their value, and you could take off those naked calls and kind of trade around your core position. But your core position is this. JT, I hope that makes sense. All right, I think that will wrap it up. No more questions. So sorry I took a little bit longer than I thought I would. Hopefully I gave you something to think about. And, if you have questions, I probably have answers. That's the best way, instead of me sitting and thinking, what should we talk about today? If you're asking questions, those are great for topic generation. And, if you bring the questions, I will promise you to bring the answers. So with that said, guys, enjoy the rest of your day. I'll be back on Friday. We'll maybe look at butterflies and whatnot. I think those are just kind of hanging out and doing nothing right now. So we're not going to talk about that. And maybe we'll come back and look at some other positions on this 112 campaign. If you need anything, you can reach me on Discord. Thanks for your time. I'll talk to you guys next time. Take care, everybody. Bye-bye.